we've seen it in India or other countries. It's like the cash will be just declared illegal. Not illegal, like okay, you will be fined, but like okay, you can't use it anymore as a currency. Like I can't use the shilling, and the Germans can't use the Deutsche Mark anymore because no, now we have the euro, and you can't pay with the other stuff. So
Mhm.
a few of them say like go in on gold, and with the gold prices, there is a very interesting take about the differences of the physical gold in the market and the paper gold market, and what the different central banks are doing right now. It's like you're the expert on this. Could you tell us a bit, or my viewers, like okay, what is going on with the central banks, with the paper market, and with the physical market of gold? Because is gold a hedge against this? Is it not really working? Is it? What is your opinion on that? All of that. Sorry if
Mhm.
the questions is a bit all over the place. Let me
Yeah, no.
clarify. What do you think about the central banks, the CBDC, and the role of gold in the future?
hmm Central banks are throughout the last couple of decades, they've either been sellers or buyers of gold. When you look at all central banks, aggregate them together, they've either been on net sellers or net buyers. And since 2008, they've been buyers of gold. And so there are certainly some central banks that have been selling gold from time to time, but altogether, central banks have been buying gold. And during 2022 and continuing into 2023, central banks are currently buying gold at the fastest pace in 70 years, since 1950. The last time they got this close was in 1967. Now, 1967 preceded 1968, which is when the London gold pool collapsed. And then 3 years after that, the gold window closed and the gold standard, the gold exchange standard ended. So basically what you see happening is central banks around the world, they are able to sniff out sovereign debt crises. They are able to sniff out when governments are not going to be able to pay their debts and currencies are going to be debased. And so they buy gold because gold is nobody else's liability. So right now you have that same thing going on. You have governments all around the world that have more debt than they've ever had. They've got a higher debt to GDP ratio than they've ever had. They've got higher rates of inflation than they've had in decades. And so they're not able to print their way out of it. And they don't have a big enough tax base to be able to tax their way out of it. And so you've either got a technical or a nominal default by governments all around the world coming up soon. And so central banks know this. And that's why they're buying gold, because yes, central banks own debt. They have treasuries, they have sovereign debt, but they're looking at this and saying there's risk of that just not having any value in the future. And if that's the case, I do still need something that has value, and they're buying gold as a result of this. And they're buying physical gold. So gold is like it's leaving the exchanges, it's going into it's leaving the system and going into central bank vaults. And so that's the first thing, is that central banks are sniffing out again something that they haven't. That it looks like they're mimicking something they haven't done since before the last gold standard ended, which was the last large, sovereign debt default. And so that's why they're buying gold right now. Now, in terms of the gold price and the paper gold market, all commodities have paper contracts that are traded for them, and that provides liquidity into the market. But you can also present some abuse on that system, and so you can go in with a relatively small amount of money and you can short gold, a much larger amount of gold than you would be able to if you had to put up the entire amount of cash for it. And so what it's possible, not proven, but it looks like what central banks are doing through other financial institutions is shorting gold to because that's selling pressure. So that keeps the price down. And then at the same time, because you receive money when you make a short, they're using that money to go buy physical gold, and they get physical delivery. And so it looks like a large coordinated scheme to keep the price of gold down as low as possible so they can accumulate as much physical gold as possible. Now, the nice thing about this is that number one, that means the price of gold is lower for anybody who wants to buy gold. It's not just lower for the central banks. Number two, it means that those shorts have to get unwound at some point, because in order to close out a long trade, you have to sell. In order to close out a short trade, you have to buy. And so any amount of manipulation that is keeping the price lower than it should be means it will eventually revert and get back to its fair value. And so what that means is that if it is happening, then buying gold right now presents an opportunity to buy a gold at a discount, and the fair value is higher than it is. And when they finally allow it to go back up, or it breaks and it forces its way back up because there's no more physical left, then the price of gold would, shoot back up to where it was supposed to be. And so I do think that following that model of what central banks are doing is smart, not for 100% of your money, but they're buying gold because they know their paper is worthless. They know their government debt is worthless. And so they're buying gold. And so we should probably do the same with at least a portion of our assets, because in the case of a sovereign debt default, in the case of hyperinflation, in the case of a deflationary debt spiral, you at least preserve your purchasing power. And maybe it gets outlawed, but at least you can still buy something on a parallel market or the black market. You have some purchasing power because that gold's value doesn't depend on somebody else making good on their promise.
The interesting take on this is with the paper gold market. It's not proven as far as I know, but it's like the gold bugs like whisper about it, that there is more gold being traded than there really is physically, because
well, that's true. That's just, you just look at the size of the futures markets and the capital required to trade that, and that is definitely true. There's a lot more gold being traded, but that's also fairly common among all commodities because of the leverage involved. And so what's debated is the conspiracy behind it, the intention behind it.
And that's also what, for example, you and others, many others on YouTube and so on, also make the distinction and tell the people between the difference of if you buy gold, if it's, I think the English term was allocated gold or not. Could you just, in a short term for the viewers, explain it?
Yeah, when you buy gold from the majority of gold dealers, if you're gonna take it and hold it yourself, and that's one thing entirely. You actually have the gold, so that's great. If you're gonna pay somebody else to store it for you because you don't want to have it physically, there's two different kinds. There's unallocated and there's allocated. Basically, it's all there, or only a fraction of it is there. Allocated means there's an actual piece of gold sitting in a vault that belongs to you and it belongs to nobody else. Unallocated, what that really means is that they owe you the gold. So if you ever call them up and say, hey, give me the gold, they don't actually have it. They go out onto the market at that point and they buy the gold and then send it to you. And so the danger with that is, in a squeeze, when everybody's scrambling to get gold, everybody's going to call them up and say, send it to me. They're not going to have the money to buy the gold at the higher price that it's at that point, and they'll go out of business. And because you're just a creditor at that point, they just owe you the gold. You may not get anything. Versus allocated gold means it's actually there. And so if something were to happen to the business, they were to shut down, you have legal ownership over that. It can't get sold and go to the creditors of the business. That legally belongs to you. So you own that gold. So you're just paying them to store it for you. So that's the main difference. You just want to look for allocated gold. It's better if it's segregated. It's better if it's insured, privately audited, and it's best if it's in a vault that's not a government vault and not in a country with a history of gold confiscation.
If you like this clip, watch another one. And if you want to see the whole interview, click here.